What's up, guys? Welcome back to another episode of Behind the Facade. I'm your host, Gavin J. Gallagher, and on this podcast, I explore the mental and emotional game often playing out subconsciously, both in your mind and the mind of everyone else in the real estate or property investment market. The key to success in this game is to master your mindset and behavior, to take control of your thoughts, your emotions, and most importantly, your ego. Welcome to the show. Guys, real quick before we begin, I have created a brand new accelerator program. It kicks off in mid-May and has an in-person welcome event starting on the 1st of June. I've put a ton of work into building this course, and it's important to point out that this is not a novice level program. It's for people who own property and want to be involved in the property business. It's aimed at time-poor business owners, corporate executives and professionals who might harbour ambitions to build their own property portfolio with the potential to fully replace their salary. Now, you may not want to leave your job, or you may not want to give it up or anything like that, but I think you will see the value of having options beyond selling your time for money. If this sounds of interest, please click the link below to book a call with me to discuss whether or not you're a right fit for the program. I do look forward to meeting you in June if you are, and working closely with you on this exciting journey. Now, back to the show. What's up, guys? Welcome back to another episode. And this week I am going to cover a topic that I have covered in the past, but this is something that I think is worth revisiting just because it's an important topic. And how this came about was I had a conversation today with a chap called Jerry. Jerry's based in Edinburgh in the UK. We had a great old chat about property, and it got me thinking about the difference in mindset between an amateur investor and a professional investor. And I'm not talking about amateur and professional in terms of, what you do for a living. I'm just talking about the approach and, the kind of thinking and the analysis that you give a particular opportunity or a deal. The reason I'm saying it, we were talking about a property that he is aware of that is up for sale, and it's selling at about a 5% yield or something like that. And he was saying his borrowing costs would be 7.5%. And he just did not understand why somebody would be buying something at a 5% yield and borrowing money at a 7.5% yield. Like that, there's straight away a loss. Now, the obvious answer to that question would be, well, the property is going to go up in value, and therefore it'll go up in value greater than the 2.5% that you're losing on an annual basis. But we were looking at the historical performance of this asset, and it had not gone up in years. And so it was highly unlikely that the person who buys it is going to do well out of it. Now, that could be a mistake. We could have misread this. This person who's buying it at that price, they might know something that we don't, and perhaps they'll do well. But more likely, in my opinion, is that people go and buy stuff because, first of all, they're not analyzing things like the asset like a professional would. They're not doing this kind of analysis and thinking, I wonder, is it a worthwhile investment? I wonder, can I recover my capital? I wonder, is this thing going to wash its face? I think a lot of the time people they've heard the old adage that you never lose money buying property. They've got it in their mind that they want to be a property investor at all costs. And so if they see something that's available, they can go and buy it. If they have the money in the bank to pay the deposit or whatever it is, borrow the rest from the bank, it can be done that. And then there's another aspect of it that I was talking about on my mastermind this evening. We were talking about the fact that if there is a property available in a town that you live in, then naturally enough, you're going to be more comfortable with that particular location because you're familiar with the area. And so if a property comes up in that area and you live there, then the likelihood is you're going to be comfortable at the idea of buying, unless you know the area to be a bad area or it's in a flood zone or whatever it might be. But if it's a good area in your mind, well, then you will be comfortable purchasing that property. And the reality is that at a 5% yield, you could go to a bigger city and you could buy another asset at a 5% yield that has a much, much greater chance of capital growth or rental growth that will increase the value of the property. But just because of your tendency to kind of like to be familiar with the area, that you'll probably be more comfortable going with the one that you know and the area that you're in. And so this got me thinking about the topic this evening, and like so much of this comes down to experience, wisdom that comes from experience, from making mistakes, obviously. But a lot of it also is just having a kind of an understanding of cognitive bias. And I've spoken about this many times before, but I know that there are new members in the audience. And so I do think it is worthwhile revisiting. So first of all, what is cognitive bias? Like, what's the definition? And cognitive bias is a systematic error in thinking that occurs when people process or interpret information. And a lot of the time, a shortcut for explaining this is that you're looking at a set of circumstances or facts, and you're saying that, yes, this seems logical. Or you're kind of looking at it and you're saying, this seems familiar. This sounds like something that's happened before, and therefore it sounds like the right answer. Or it sounds just correct. Yeah, that sounds about right. And people make these snap decisions based on cognitive bias. And it is because our brain likes to take shortcuts. One of the reasons why people establish habits is because it's a shortcut. If you brush your teeth every morning and every evening before bed, most people will not even have to think, I better go and brush my teeth. They will just do it because it's a habit. But you weren't born with that habit. You had to install that habit. And it's the same with this. Your brain automatically looks to repeat patterns that it has done before, or things that seem logical, that seem familiar and seem correct. So let us use an example here. And this is an example I've used in the past, but it's a good few years ago at this stage now. So it's still relevant. And let's say that you are sitting at a restaurant and you overhear people at the next table talking about the stock market. And you just can't help but overhear that they're talking about a particular stock that is on the stock market, that's in the news. And you hear these people saying, yes, it's definitely going to go up. It's definitely, there's all sorts of reasons why this property, this asset, this stock, whatever it might be, is going to keep on going up, up, up. And it's a great time to buy. So you're overhearing this. Now, whilst you're overhearing this, you're subconsciously looking at who is giving this information. Even though you don't know this person, you might notice he's well-groomed. He's of a certain age that, probably got some wisdom, wearing a sharp suit, and he's talking to other business people. And so this is a business conversation, and this person seems like they would know what they're talking about. So that registers in your brain. And maybe you go off, maybe you investigate the stock, maybe you put some money into it, who knows. But let's fast forward to the next day. And let's say you're walking down the street, and as you're walking down the street, a homeless guy is asking for money, and you're walking by. And as you're rummaging through your pocket for some change, he says, thank you very much, sir. I'm going to give you a stock tip. You should go and buy shares in this company. It's going to do really well. I do think you should go and buy it. Now, as you're walking away from this conversation with this homeless guy, you realize that it's exactly the same information you heard the day before, but it's coming from a homeless guy on the street. So how much validity do you give to that stock tip? How much authority do you give to the homeless guy versus the guy in the business suit sitting in the fancy restaurant? That is what's known as a framing bias or an authority bias. And this happens a lot. People just make these snap decisions based on where the information came from. Now, the information in this case was identical. 24 hours apart, the exact same company, the exact same stock tip, the exact same reasons why it's going to go up. But You're looking at it and you're saying, it's this guy here looks successful, wearing a suit in a fancy restaurant, looks well groomed, seems like an intelligent man. This homeless guy, like, drunk, probably, slept out there all night. Why would you give any weight to his opinion over this business person? And that is the problem, is that the information is identical, but you have framed it a certain way coming from one individual versus another. It's exactly the same information. And that's the point that I'm getting at. It's exactly the same information. The person who gave you it is the reason that you're valuing one over the other. Now, the correct thing to do is to ignore both and to go away and do your own homework and come back with an assessment of that stock and why is it likely to go up. Maybe there is reasons that it looks like it's going to go up, but you're the one who needs to do the homework, not do the shortcut of listening to a person who gives you a stock tip. And I've made these mistakes before. Just don't abdicate your decision making to another person. That's the first rule. But second of all, any time there's this kind of quick, get rich quick kind of decision being made, most of the time it's going to burn you. And, we're talking about Mental Health Week this week. And over the years, I've made those kind of decisions that have been cognitive bias, flawed mistaken judgments, mistaken thoughts, went ahead, purchased, and then I have to deal with all of the stress that comes later. And so, this being Mental Health Week, let's just pay attention to some of this stuff. The next thing I want to talk about is the confirmation bias. Another cognitive bias is called confirmation bias. And this is one that over the years, it's quite a dangerous one because it's very easy to fall into this trap. And this is where you subconsciously seek out information or data that confirms a decision you have already made. And so what I'm getting at here is, and to use an example, my deal in Spain, the big property deal that I bought many, many years ago, and it cost me an absolute fortune. But what happened in that particular case is quite interesting. I went down there and I got a feeling I liked this location. I liked this site. I liked this idea that I had. And if I'm honest, I probably fell in love with the idea when I should not have. But sometimes you have to be aware of yourself and your emotions and stuff. I fell in love with the idea of this deal long before I had the information to back up whether it was a good deal or not. I went off and I spoke to my lawyer in Spain. He thought it was a great idea. I spoke to the people who were selling me the property. They told me all the reasons why this is a fantastic idea. Then I spoke to an agent and an advisor, property advisor. And he said, I'm not so sure, Gavin. Are you sure? Do you really want to go ahead with this? So what did I do with that question mark? I went and I ignored it and I asked another advisor for an opinion. And that advisor came back telling me, great idea, you should do this deal. Fast forward a couple of years and the deal was a complete meltdown. And I realize now that I had succumbed to confirmation bias. I had decided I wanted to do that deal long before I had the evidence to support the decision. And because I had made that decision, I was now looking for evidence to support what I had already decided to do. It wasn't the other way around, which is what it should be, is that I haven't made my mind up yet. The data will confirm whether it's a good idea or not. And then you go ahead. So be very careful that you are not primed to buy something in advance of getting the information. And don't be looking for supporting information that backs up your hypothesis. Just go out there, be like, to use Stoic philosophy as an example, just use, your judgment and don't make a predetermined decision. Just say, you know what, we'll see what happens. We'll see what the evidence comes up with. And if it looks good, we'll go ahead. But if it doesn't look good, I'm not falling in love with this property in advance of getting that information. Now, the next cognitive bias I'm going to talk about is one called continuity bias. And continuity bias is the tendency to disbelieve or to minimize threats or warnings because of your default mindset is that the current status quo will continue. Now, this works both in a positive way and a negative way, because in 2020, we were all in the middle of COVID and interest rates were very, very low, and they started to get even lower. And everyone was starting to buy property after COVID, after the initial lockdown where you couldn't do anything. Suddenly there was this rush to buy property and everyone was buying it. And why was it taking place? It was taking place because of low interest rates. People could see that interest rates were like hovering around zero at the time. And everybody thought that this is going to be a low interest rate environment for a prolonged period of time. I remember having a conversation with an investor, and I wish I could remember who it was, but I remember we were talking about interest rates, and he said that he saw no circumstances in which interest rates could increase in the next 10 years. And when we were like, why do you think that? He says, well, what would trigger it? Like, inflation is under control. All of these other factors are under control. Like, there's no reason for interest rates to increase. And so, sure enough, that was the status quo. And so this person was convinced that the status quo was going to continue. And as we know, along came inflation, and interest rates have since gone up like 5% in that period. And this is a real problem. Like, this whole idea of just whatever the prevailing environment is, that's what's likely to happen. Now, this happens both when the market is hot and you kind of think it's going to continue to be hot. It happens when the market is really bad and you think that it's going to continue to be bad. And a lot of the time, this is why people don't buy life insurance, because they don't really think the likelihood of them being dead by the end of the year is likely to happen. So they just, it's not seen as a threat. Like, they think that they'll continue to go on living. And so, sure enough, people do get into car accidents, do get into things, and they leave behind a family and there's no life insurance in place. How do I know this? Because when my dad died, there was no life insurance in place, and we had to try to scramble to figure out like what to do. But he had never imagined the possibility that he might die. And I don't think his health would have been great for a medical anyway. But this is what happens. People just assume that the status quo that you're currently in will continue. And that is why things like war and stuff catch the market off guard, because most people don't think that a war will break out. But when it does, suddenly it's like catastrophic result in the stock market. The next cognitive bias that we're going to talk about is one. It's a complicated name, but it's a simple enough concept, and that is availability heuristics. And what this is where there is a collective belief, or when there's lots of information that is readily available. And so what I mean by this, basically it's like the crowd. When the crowd believes something is going to happen, then everyone starts to believe that it must be so. And if we go back to 2005, 2006, when the market here in Ireland was overheating, and it was overheating around the world. Like in the US, it was overheating. In the UK, it was overheating. The whole world was enduring, was going through this kind of credit bubble, and everyone was overheating. And every time anyone was to raise the alarm and go, guys, this is not normal, this is not going to happen, there was so much information in support of ongoing growth and ongoing continuation of the situation. There was not very many articles out there saying that there's going to be a total and utter collapse of the market. And because of that, most people put more importance on the one that is readily available. So if you're reading every day that the market is great, it's going to keep on being great, then that's what your prevailing thought is going to be. That's the available heuristic. Whereas if you read one article that says that the market's going to collapse, but you've read 99 articles that says it's going to continue to go, of course you're going to place more importance on the one that's 99% in favor. And the reality is that is where people, the market, the herd mentality gets you in trouble. And this is where contrarian investors, they book that trend. They bet against the herd. And a lot of the time they make an absolute fortune. If you go back to the 1980s, I think it was, and George Soros, who's now in his, I think he's probably, late 80s or 90s now, but he started betting against the Bank of England, and he made this an enormous bet against the devaluation of the pound, and he bet that it was going to happen, and he actually bid up the price, and anyway, lo and behold, the Bank of England ended up having to devalue, and he made £1.5 billion in one day. And he was able to make that because he bet against the market. Everyone else kind of believed it could never happen, but he was sure that it could happen. And this is also, if anyone who has seen the movie The Big Short, that's a great movie to explain the credit bubble of 2008 when it all came crashing down. And the famous investor in that movie is a real guy. It's actually based on a guy called Michael Burry. And if you go and follow Michael Burry online, you can actually find information about Michael Burry on Twitter and things like that. But he believed that the entire market was overheated. He believed that there was a credit bubble, and he believed that real estate prices were going to collapse. And he had all of the data, showed everything was going to happen. He had figured it all out. He said, no, it's absolutely guaranteed. The market, all of these, like these guys that are borrowing all these millions, they can't afford to make the repayments. So there's going to be a massive correction. And that was his belief. And he went off and he bet completely against everyone else's belief that the market was going to continue going. He bet the market was going to fall. And the pressure that he faced from his own investors that were investing with him, they were all saying, you're crazy, you're mad, like this is a crazy trade that you're doing. And he stuck to his guns despite all the pressure. Lots of them were like demanding they get their money back and all this. And in the end, he made a couple of billion when the whole thing corrected. And he was able to go and write to them and say, you're welcome. After all of the pressure, them calling him an idiot, all this kind of stuff, he was able to go back and say, there you go, there's your 700 million profit that I've made for you. You're welcome, by the way. That's a great example. Now, the next cognitive bias that I want to talk about is one that's not spoken about so much, and that is survivorship bias. And this is the tendency to listen to the insights and opinions of survivors or successful people. And so this is one of the reasons why you go into a bookstore and walk over to the biography section. You're going to see biographies on Steve Jobs, Richard Branson, Mark Zuckerberg, Jeff Bezos, the list goes on. You name the business icon and there will be a book about that person. And this is because they're successful. They have survived the arena, the business arena. And they're able to tell their story about how they did it. And people want to know, how did they do it and all this. Have you ever gone out and bought a book from an author who suffered a devastating loss, who went out and tried to start a business and the whole thing collapsed and he lost his family home and he did all of this stuff there? Those of you who want me to write my book, go and send me a message and I'm getting some ideas about writing a book. But this is the kind of thing that most people are not interested in reading about the losses, reading about the mistakes. They want to read the kind of inspiring story about how a 20-year-old can go and become a billionaire. But the reality is you go and read the story of somebody who tried very hard, smart guy, went out, bought a load of stuff, tried to go and sell it for a profit, and sure enough, the market moved against him and he lost it all. That doesn't sound very inspiring, but probably in that story are so many insights that are valuable, so many insights that will steer you away from trouble, so many insights that you can use in your own life and are quite relatable. Try to be, to apply those kind of things to the likes of Mark Zuckerberg. Like, he is one in maybe a 5 billion planet. He's one guy that created Meta in his dorm in university. Steve Jobs, the same. Like, these are individuals that are quite unique, and they come along once in a generation, generally speaking. And we all want to read about them. But why don't we want to read about the guys that lost a load, that could actually educate you how to avoid it, rather than reading about, like, we all love reading about Napoleon Bonaparte. They say that he was he was a person that would only come along once every 10,000 years. That's how kind of intelligent he was and things like that. Sure enough, he met his end, but they're all writing about him 250 years later. And so it does say a lot about the survivorship bias that we all have. Survivors get all of the attention, and the people who don't get the attention are the people who are dead or who got wiped out. And so just remember that when you're reading a book about somebody successful, remember that these are the opinions of somebody who survived and made it through against the odds. And they're not going to tell you the stuff that went wrong for them, because it didn't go wrong for them. The stuff that's likely to catch you out didn't happen to them. And therefore, you're not necessarily going to learn as much from them. It might be an inspiring read. The next cognitive bias that I'd like to talk about is present moment bias. And this is the tendency to opt for an immediate reward over something bigger in the future. And a lot of people succumb to this. And this is something that I often talk about, the importance of patience and discipline in the property industry. And this is, again, getting back to the fact that we're in Mental Health Week, Awareness Week, I think it is at the moment. Like, get rich quick schemes are all about present moment bias. It's, you want to get some money right now. This guy over here is making a suggestion that if you do this and this, you can make a fortune really quick. Whereas this person over here is telling you, if you lay down the foundations and if you go and play it smart, and if you're patient and you take your time, you can build a fortune nice and slowly over a long period of time and be really and really enjoy success. That's a long time. I prefer this guy's story over here, who tells me I can be rich in a year. And so that is a get rich quick scheme. And so many people succumb to these kind of things. And that is because of present moment bias. And I was reading today, this morning, I opened up Bloomberg. They have a page on, Bloomberg Business has a page on Instagram. And I saw it and I went in and I had a read of this article. And it was about a thing called the I Am Academy. And the I Am Academy is this sort of online courses thing that was set up. And it was set up by a guy in the US, and basically teaching you how to trade currency, crypto, stocks, all that kind of stuff. And the guy basically described himself as the Harvard of trading. And guys would go in and you'd have to pay so much to become a member, and then you'd get all this kind of stuff. And anyway, they described how, like, literally thousands of people all around the world have lost everything that they put into this thing. And sure enough, why? Because it's a get rich quick scheme, and people were made promises that if you buy the stock at this price and then sell it, we all saw Wolf of Wall Street. The guys were pumping the stocks, and then when everyone has bought it and the price has gone up, then you dump the stock. And so you're getting out at a massive profit, but you're getting out at the price that all these other people have piled in. These guys, every time people lost, they would be like, what am I doing wrong? And the guys would be telling them, like, you didn't move fast enough, or you didn't do this, or you didn't do that. It was always their fault. It was never the Academy's fault. Anyway, according to this article I read in the Bloomberg today, lots of people all over the world, like Manila in the Philippines, Holland, the UK, Germany, Spain, like even in Spain, Spanish government actually requested that a conference in Dubai would be shut down because these guys were promoting stuff there, and the Spanish government knew about thousands of people in Spain that had been taken by this. Anyway, enough on that. Let's talk about restraint bias. And it's kind of related, but this is the tendency to overestimate your ability to show restraint in the face of temptation. So when somebody comes along and offers you a get-rich-quick scheme next year or next week, you say to yourself, I just heard Gavin say how bad that is, and so I'm not going to do it. Wait until the guy is dangling money in front of your face saying, you can be rich 1 week from now. You go and buy this stock, I'm going to make you rich. And this is why crypto did so well, because everyone saw a load of people making a load of money. And so clearly somebody's making money somewhere. And so I want to ride that train as well. And so sure enough, you jump in. And then the problem with a lot of these stocks and share tips and all this kind of stuff is that there's no underlying fundamental reason for the price to go up. All it is that it's kind of in a hype cycle, and you're buying it from somebody and they've made a profit selling it to you, and you're hoping to make a profit selling it to somebody else. But as long as it keeps getting hyped, you're always going to make some money. But the problem is the hype stops at some point. And we've all heard about GameStop and these things. Anyway, the next one it's one of the reasons, by the way, why easy credit, like the credit crunch that we had back in 2008, like that was because of the danger of easy credit is that most people, they go and they do an equity release on a property. Let's say they bought something at 200 grand and it's gone up to 300 or 400 grand or whatever. You go to the bank and say, I'd like to release some equity, and they give you 100,000. And you say, okay, I'm going to use this to go and buy, another investment property. So the 100 grand is sitting in your bank account, and it's sitting there and it's burning a hole in your pocket, and you're like thinking, I have to do something with this 100 grand. And then sure enough, something comes along. And even though you've promised yourself that you're going to be careful, you're going to, work carefully, apply due diligence, all of this stuff, you make these convincing arguments to yourself. The reality is a lot of the time, your restraint is just not as good as you think it is. And you'll jump into an opportunity, maybe just a little bit too quickly, because you're not as good at showing restraint as you thought you were. And then let's see, the final one that I'm going to talk about today is disposition bias. And this is probably the best one to describe for property investors, because this is a thing, I've seen this a lot. And let's say it's where you sell your profits and you hold your losses. And a lot of people, I talked about at the start of this, I talked about how it seems logical, seems like the right thing to do. Let's say you buy two properties and you pay 100 grand for both of them. So you hold two properties, you paid 100 grand for both. A year later, you're having a look at the performance of your two properties. One has fallen in value 25%, it's now valued at 75, and one has risen in value by 50%, and it's now worth 150 grand. So you're up 50 grand on one, you're down 25 grand on the other. And if you had to sell one of those, which one would you sell? And if you ask that question, the vast majority of people will turn around and say, that's easy. I'll sell the 150. I'll take that 50 grand profit and put that in my pocket. And yes, it does sound logical. But the reality is most people, they just don't want to crystallize the 25%, the 25,000 loss. But you have to look at the assets themselves, and you have to try to figure out what is driving the price rise and the price fall in the case of both properties. Most people will sell the 150 just because it's risen 150, not because of the underlying reason why it rose 150, just because it's gone up, the other one's gone down. And that is the rationale behind the decision to sell for 150. Now, the reality is, if that has risen to 150, a year from now, who's to say that it hasn't risen to 250 or 300? And the same property that you bought that's at 75, that could still be sitting at, languishing at 75 a year after. Sometimes you buy something and it does badly, and that has to be accepted as a risk as an investor. You go out there, you buy something, you're going to drop the ball, you're going to make a mistake, you're going to have misread a situation, and perhaps the best thing you can do is sell that 75 grand, take the loss, get the 75 back, and maybe you can go and buy something that will perform more like the 150. And you've at least been educated on why that one fell and this one rose. Try to buy something like this one that rose. And that would be the smart thing to do. But your disposition bias will force you a lot of the time to think that the one to sell is the one that's winning. And they always say, stock market traders say, you run with your wins and you dump your losses. And so that's how they've kind of programmed themselves. So guys, I strongly urge you to study cognitive bias. Do it in your own time. Look, go into ChatGPT, ask it to summarize the big cognitive biases, and it will list these things out. And it's really important just to read them so you understand the mechanics of your mind and the shortcuts that you're taking. And this is something that I do cover in my accelerator. And the reason I'm mentioning the accelerator is because onboarding commences next week. And so I am just letting you guys know that we finally reached the launch date. If any of you are still sitting on the fence thinking about, I wonder what that would be like, there's still a few spots left. Not many, but I do have a few available. So if you are interested, please jump in. You'll find a link to book a call with me down below in the show notes. Use that link, book a call in, and we'll have a conversation. But other than that, I hope to see you guys next week. Take care. Thank you for tuning in to another episode of Behind the Facade. If you enjoyed the show or found it in any way useful, could I please ask you to take a moment to leave a review over on iTunes or Spotify. This really helps us get the podcast out in front of more people. If you have any questions or topics you would like me to cover in future episodes, please connect with me via my brand new school community. You will find a link in the show notes. You can stay up to date with all of my content and the projects I'm working on by signing up for my weekly newsletter over on my website, gavinjgallagher.com. That's all for now. See you back here, same time next week.